Welcome to Venture Capital's Silent Partner, LPs Revealed, the power behind the curtain. Today, we're pulling back the curtain on the true engine of the VC ecosystem. While venture capitalists or general partners often get the spotlight, the real power lies with the limited partners, the LPs. Limited partners are the essential source of capital, providing over 90% of the money that VCs use to invest in startups. Without LP money, VC firms cannot raise funds or deploy capital. LP sentiment and their allocation decisions fundamentally shape the entire venture capital cycle. Their willingness to commit dictates whether the market sees boom years or down cycles. So what exactly is a limited partner? They are the investors in the VC fund itself, providing capital but maintaining a passive role with limited liability. LPs supply the funds but are explicitly not involved in the day-to-day management or investment decisions of the venture capital fund. A key feature for LPs, especially large institutions, is that their liability is legally capped at the amount they invest. This limited involvement also means VCs are required to maintain high confidentiality, often reporting only on a quarterly basis. In the rest of this video, we will break down the LP composition, their immense influence, and the critical financial metrics they use to judge performance. The financial metrics LPs focus on are not just abstract numbers, they are powerful mechanisms that ultimately determine the flow of capital and fundamentally shape the entire innovation economy. Let's examine the scale and structure of these massive investment institutions. LPs operate with broad global mandates, allocating funds across various asset classes beyond VC, including private equity, infrastructure, and credit. These allocation decisions are rebalanced annually based on macro trends. Importantly, LPs are moving towards having fewer but much deeper relationships with general partners. The primary sources of LP capital are pension funds, endowments, and sovereign wealth funds. Pension funds represent the largest LP category. They seek stable, long-term yields to ensure they can pay benefits to retirees, making them patient capital providers. University endowments were some of the earliest and most aggressive backers of venture capital, famously adopting the Yale model that encourages a higher risk appetite for long-term growth. Sovereign wealth funds, funded by national reserves, are the fastest-growing LP segment and often take aggressive positions in frontier and deep tech sectors globally. Family offices are also becoming increasingly critical. They are often more flexible, faster-moving, and are rapidly increasing their allocation to early-stage venture capital. We are talking about trillions of dollars and a required 10-year lockup period. LP money is essentially locked up for 10 to 12 years. This patient capital allows VCs to take high-risk, long-duration bets on groundbreaking innovation that traditional finance cannot support. This extended commitment means LPs rely heavily on the stability, succession planning, and historical performance track record of their general partners. How exactly do LPs vet the funds they invest in? It comes down to a rigorous due diligence process built around specific financial metrics. LPs review the GP's sector expertise, the coherence of their strategy, and the depth of the team. They put a strong focus on portfolio construction discipline, including the number of investments and ownership targets. Let's look at the key metrics: internal rate of return, or IRR, and total value to paid-in capital, or TVPI. IRR is highly sensitive to the timing of cash flows, meaning early paper markups can often be misleading, potentially overstating actual performance. TVPI is often the preferred metric for comparing funds, as it reflects the true long-term value created relative to the capital contributed by the LPs. LPs carefully scrutinize the, quote, unrealized portion of the TVPI, as this impacts liquidity predictions and confidence in future cash distributions. Next is distributions to paid-in capital, or DPI, which is currently the gold standard in a tighter liquidity market. DPI represents the actual cash distributions LPs have received. This metric is crucial for evaluating a GP's ability to achieve successful exits and return capital. A persistently low DPI is a major red flag, especially during recessionary periods, as it indicates a failure to convert paper gains into actual cash returns for the LPs. Now let's examine the mechanics of capital commitment and the crucial strategies LPs employ for risk mitigation. LPs spread their risk across multiple dimensions, geographically, strategically, by funding seed, growth, and sector funds, and across different managers, balancing emerging GPs with established players. Commitment pacing is a deliberate strategy used by LPs to avoid clustering their investments in overheated vintage years, which helps safeguard against valuation bubbles. LPs must maintain significant liquidity buffers because capital calls from VCs are unpredictable, and they must meet these obligations swiftly. Failure to honor a capital call can lead to severe penalties or even the forfeiture of the LP's interest. Furthermore, GPs increasingly utilize recycling provisions to reinvest early gains back into the fund. A crucial risk mitigation technique involves diversifying by vintage year and across fund stages. Vintage diversification helps LPs protect their total portfolio value against large macroeconomic cycles and market-wide valuation bubbles by spreading investments over time. Allocating to late-stage funds and growth equity provides a necessary counterbalance to the inherent high volatility and longer time horizon of early-stage venture funds. Despite their passive status, LPs exert profound, often unseen, influence on the investment theses of venture capital firms. LPs closely review a GP's sector exposure, focusing heavily on areas like climate tech, AI, and enterprise SaaS. Their stringent reporting demands also force VCs to adopt sophisticated, data-driven portfolio monitoring systems. In fact, many large institutional LPs now mandate clear ESG and impact frameworks as a condition for making any capital allocation to a fund. The preferences of LPs, especially regarding ESG and DEI mandates, indirectly steer the entire venture capital thesis by prioritizing certain investment sectors and policy adherence. By allocating capital, LPs can shift entire markets, pushing VCs towards critical areas like AI safety and climate tech. Their DEI policies directly impact a startup's hiring practices and board composition. The constant need for distributions to paid-in capital, or DPI, creates immense pressure on VCs to deliver successful exits through M&A or IPOs. LPs expect regular cash distributions, and the current sluggish IPO market means VCs must aggressively pursue acquisitions and secondary sales to satisfy this demand. Crucially, a lack of consistent DPI, a DPI drought, can severely compromise a GP's ability to raise subsequent funds, emphasizing that returning capital is as important as generating paper gains. The role of the LP is not static. It is rapidly evolving, leading to blurring lines and increased direct involvement. Mega LPs, such as Canadian pensions and sovereign funds, are increasingly establishing direct investing arms to participate alongside their GPs. They are also rapidly increasing their allocations to credit and secondary markets. LPs are demanding greater transparency, requiring real-time dashboards, detailed risk metrics, and clear alignment on non-financial mandates like ESG. The increasing participation of LPs in co-investments and the establishment of internal venture arms are blurring the traditional roles between LPs and GPs. LPs are motivated to co-invest to achieve lower management fees, secure larger exposure to high-potential portfolio companies, and gain valuable board observation rights. The future of the LP-VC relationship is being defined by a heightened focus on impact and advanced data tracking. LPs are central to the global shift towards impact investing, directing massive amounts of capital towards sectors like climate tech, responsible AI, and scalable healthcare solutions. They are increasingly demanding measurable impact metrics, not just promises, including carbon footprint data, diversity targets within the fund and portfolio, and strict governance checks. As the data capabilities of LPs grow, allocation decisions are becoming even more granular, relying on deep data analysis rather than solely on historical relationships. In conclusion, limited partners are the silent yet powerful force driving venture capital. Understanding their motives, metrics, and influence is essential for anyone in the innovation economy. Please note this content is for educational purposes only and not financial advice.